Welcome, G-traders. The reaction of markets worldwide to yesterday's Fed key rate decision showed how huge the influence of the US regulator on the movements of a currency and stock assets was. The Fed hiked the interest rate more aggressively to return inflation to the 2% target. According to the Fed's forecast, the central bank will start cutting interest rates in 2024. Speaking at the press conference, Jerome Powell confirmed that the Fed raised the key rate by 75 basis points following an 8.6% rise in the CPI index and University of Michigan inflation expectations. Powell believes that more aggressive tightening is appropriate now. However, further moves will depend on economic data. He also stressed that many factors that the Fed doesn't control are going to play a very significant role. 10 out of 11 voting members were in favor of a more aggressive hike. Only Esther George preferred a smaller 50 basis point increase. It's rather surprising given that she has always been a hawk. Powell pointed out that from the perspective of today, either a 50 basis points or 75 increase seems more likely at our next meeting. However, he warned that rising commodity prices could jeopardize a soft landing. Besides, tightening financial conditions would affect economic growth. We want to see a series of monthly declines in inflation, Powell added. That's the Fed's main priority. It appears investors are fine with such prospects. In the long term, the US economy will benefit even more, while in the short term, inflation will soon be taken under control. After the Fed hiked the interest rate aggressively and downgraded its economic outlook, risk appetite managed to increase. The US dollar fell from its 20-year high. However, analysts are confident that the greenback is likely to resume its rise given the aggressive monetary tightening. So, in today's Asian session, the US dollar has already slightly recovered to 105.18. The US dollar index, which measures the strength of the currency against six main rivals, was trading in the sideways channel of 104.71 and 105.49. The US dollar climbed mainly because of the weak yen, and the risk on sentiment in the stock market undermined the yen's rise as a safe haven currency. Its upward movement was rather limited in the Asian trade. As seen on the chart, the dollar-yen pair lifted up by several pips to 134.62 from the swing low. After that, there was a pullback. The pair was moving downwards in the range of 133.57 and 134.67. Now the price is hovering on the level of 133.33, the support level of the previous range. The Aussie is still unable to gain momentum against the US dollar. However, stocks were able to add gains. Given the correlation of US stock indexes with the Aussie, the latter slightly climbed. It also moved up as a commodity currency. Oil prices grew after falling by more than 2% following the Fed's decision. Analysts note that the Reserve Bank of Australia has started monetary tightening relatively late. China, Australia's main trading partner, is dealing with the negative consequences of the coronavirus outbreak in the main financial hubs, such as Beijing and Shanghai. During the Asian session, the Aussie was trading in the bearish channel of 0.6951 and 0.7038. At the time of preparing material for this video, the AUD-USD pair had already reached 0.6973. And that's all for now. Thanks for watching our first video review of the Asian session. Don't miss our next videos on the European and the US sessions. Subscribe to our channel and learn only the latest market news. See you soon.